Welcome back to the channel. I'm your host Jamie and you're watching the Crypto Weekly Update. In this video, we'll summarize all the major events that happened in crypto over the past week, breaking it down into bite-sized information to make it easier to understand. If you like this type of direct content, make sure to stay tuned and watch the video until the end. Alright, let's get started with our first big news in the crypto space. Bitcoin took a sharp dive at the start of October, a month traders often hope will bring gains. Historically, 9 out of 11 Octobers have tended to perform well for Bitcoin, but at least in the first week of October this year, we are not so much seeing the returns we hoped for. One of the biggest reasons we didn't see the pump was the rising tension in the Middle East. Israel, which has been fighting Hamas in Gaza for almost a year, has sent its troops into southern Lebanon after 2 weeks of intense airstrikes. The impact of Iran's missile attack on Israel has mainly been felt in the financial markets, driving investors towards safe haven assets like the US dollar, which has reached 3-week highs. While I know there are bigger issues to be concerned about during wartime, and my heart goes out to those innocent people, since this is a crypto channel, I'll stay as objective as possible and focus on the financial aspect here. Oil prices increased by 2% due to fears that a broader conflict could disrupt supply. However, analysts suggest that high US crude inventories and OPEC's spare capacity will likely prevent significant price spikes at the pump. Meanwhile, Bitcoin is still up 16% over the last 30 days thanks to the Fed's rate cut. Even though October usually brings price hikes, this recent dip has some traders feeling uneasy. However, we are just entering the second week of October, so who knows if the anticipation of the US presidential election might create some upward momentum in the market. Grayscale has launched a new fund offering exposure to AAVE, marking another addition to its growing lineup of crypto investment products. If you had used AAVE before, you'll know that it is a lending protocol that allows users to borrow and lend crypto by using their own assets as collateral. In return, they will earn interest on their deposits. It has now become the largest crypto lending protocol by TVL, reaching a market cap of $2.3 billion according to Llama. Grayscale's head of product and research is particularly bullish on AAVE, noting its potential to disrupt TradFi by leveraging blockchain technology and smart contracts. The AAVE Trust launch follows Grayscale's Avalanche Trust and adds to the over 20 crypto products offered by the asset manager. As you know, Grayscale is known for products like the Grayscale Bitcoin Trust and Ethereum Trust and has seen an uptick in demand for publicly traded crypto funds, especially after the introduction of spot Bitcoin ETFs earlier this year. Overall, it's great to see more products available for different types of investors, and it looks like Grayscale will continue adding to its crypto offerings. Moving on to the next piece of news to put strike. Another major concern for the US economy is the Dockworkers strike that spans from Maine to Texas over wages and automation. However, there may finally be some relief in sight. This strike impacts 36 key ports that handle over 75% of the nation's banana imports, holiday goods, and essential items. It's the biggest strike in nearly 50 years and could cause serious supply chain disruptions, from toy shortages to delays in auto parts and coffee shipments. According to JP Morgan, the strike could cost the US economy between $3.8 billion and $4.5 billion per day. The fallout isn't limited to the East and Gulf Coast. It could also disrupt West Coast ports, creating chaos in the shipping industry well into 2025. At the onset, people rushed to stock up on food and essentials like toilet paper. But looks like a settlement has now been reached, which includes a 62% pay raise over 6 years, raising wages from $39 to $63 an hour. Both sides have agreed to extend the master contract until January 2025 to continue negotiations on unresolved issues such as automation, which workers fear could lead to job losses. Although President Biden has backed the union, it feels like they're just kicking the can down the road, with unresolved issues and the risk of job cuts still looming. The UAE's Federal Tax Authority, FTA, has announced key changes to its VAT regulations starting on 15th of November. One of the biggest updates is that the transfer and conversion of virtual assets, including cryptocurrencies, will be VAT exempt. This is great news for individuals and businesses involved in crypto, as they will no longer pay VAT on these transactions. The FTA also simplified VAT rules for exporters. They can now use a variety of documents like custom declaration or shipping certificates to prove exports, making the process much easier compared to before. For financial services, the changes go further. Managing investment funds, transferring ownership of virtual assets, and converting them are all now VAT exempt, with this new rule applied retroactively from January 2018. Fund managers will now want to see if their services fall under this exemption, as it could impact VAT recovery and reduce costs. Lastly, businesses involved in crypto should review how these VAT exemptions affect the filings, especially if they've previously paid VAT on virtual asset transactions. Some are calling the UAE the crypto heaven for the rich. But for me, I just find it fascinating how some countries are so forward-thinking, while some are considering taxing on unrealized gains. Meanwhile, in Singapore, there's new consumer protection regulations coming soon in 2 phases. The first phase starts in October this year, focusing on safeguarding customer assets, improving disclosures, and enhancing risk management controls. Licensed firms must ensure that customers' assets are ring-fenced and clearly communicate potential risks. The second phase will roll out in June 2025, requiring crypto firms to assess retail investors' risk awareness before providing services. Firms will be prohibited from offering incentives to retail customers, and retail investors cannot use credit, leverage, or derivatives tied to cryptocurrencies. They claim that these measures are to protect consumers in a volatile market, learning from the mistakes seen with FTX and Terra Luna. While the rules may make it harder for average consumers to access digital payment token services, some believe they will help create a more informed customer base. So, stifling or not, I'll leave it to you to decide. Coinbase will delist Tether USDT and other stablecoins that do not comply with the EU's MiCA regulations by the end of 2024. MiCA, which sets market rules for digital assets, requires stricter compliance for stablecoins, including a mandatory one-to-one reserve backing. Coinbase plans to assist its European customers in transitioning to compliant alternatives like USDC. MiCA's rules target various types of crypto assets, including stablecoins, and ban algorithmic stablecoins due to the risk of collapse. Fiat-backed stablecoins face tighter controls, though Tether's reserves meet some requirements. However, USDT still falls short of specific MiCA conditions for stablecoin issuers. Some call this necessary protection for users, while others see it as a conspiracy to push out USDT and favor USDC. Since Circle owns Coinbase and Coinbase is largely backed by BlackRock, so it makes sense that USDC is getting the green light everywhere. Anyways, let me know how you feel about this regulation. Do you like it or not? Comment it down below. That's it for this week's news update in crypto. If you want more information and want to stay up to date with the crypto industry, follow us on Twitter too. Links can be found in the description box below. Thanks for watching, and I'll see you guys in the next one.